Sun Pharma, that's the top loser on the Nifty, down 2% after the company's Basca facility receives an OAI from the US FDA.
Stocks of capital market players rally as SEBI revises the expense ratio for mutual funds. All statutory levies are excluded from the base expense ratio, which has been cut across schemes. Limits on brokerage for derivative and cash trades by EMCs also capped at 2 basis points and 6 basis points respectively.
Shares of Anthony Waste Management rally over 18% as the company's joint venture wins a 7-year order worth about 1,300 crore rupees.
Ola Electric slumps close to 4% as the promoter, Bhavish Agarwal, sells stake for a second straight day. 4.2 crore shares sold today after a sale of around 2.6 crore shares yesterday.
Shares of Crompton, they rally as Motilal Oswal initiates buy rating on the stock with a target of 350 rupees, expecting compounded profit growth of 21% till FY28.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and the markets have recovered from the lows of the day. Earlier today, we were pointing out that the FI net short positioning had moved to around 92%, which normally is getting a little bit excessive, and the PCR as well was coming to the lower end of the range. And after starting off in the red, from the lows, we've seen a bit of a bounce. Let's see whether or not it's sustainable, Mangalam, but we're counting down to the end of the year.
Counting down to the end of the year, let's see whether Santa visits the Bulls this year or visits the Bears this year. But importantly, even as the market has recovered from the lows, the broader markets, they continue to be in a bit of a tizzy right now. The mid-cap index, while off lows at an index level, if you look at the broader, the crisscross lines, they've neither crissed nor crossed. Over the last 2 trading sessions, we saw nearly 2,000 stocks declining for about 700-800 which are advancing. Right now as well as we speak, about 1,800 stocks which are in the red, for 900 which are in the green. So let's see how that turns and whether that turns to in the favor of bulls at some point or not. Bunch of stocks doing well. We did speak about the kinds that were moving on the back of news, but we have a few of these pharmaceutical stocks as well which are buzzing around. Biocon, Divi's Labs. There is some traction on a lot of these mid-cap IT names as well. Good time to welcome Sachidanand Uttekar of Trade Bulls for a quick technical check on the market. Sachi, we've recovered from the lows today, managing above the 50-day moving average of the Nifty for the last few trading sessions as well. Do you think this is an important base formation and we move higher from here, or this is just a flash in the pan?
Good morning, Mangalam. I think it's a very significant level. The 50-day exponential moving average, which is placed at 25,740, has again acted as a very good support zone. Now, we have already seen a strong rebound, which may get carried forward throughout the day. But it is very important for the Nifty to decisively give a closing above that 25,880 mark. On the higher side, still, I think there are multiple hurdles, still 25,930. So these are the key resistance levels that we are watching out for. But on the lower side, I think the decline has been very gradual for the last 4 trading sessions, though there is a low top, low bottom sequence on the 60-minute scale. But if things have to change, I think this particular support should be maintained on closing basis. So I think it's a very significant level, 25,740 on the lower side. And on the higher side, we need a decisive closing above that 25,880, 930 kind of a cluster. And once that particular level is crossed, then we may see a good, strong revival in trend. As of now, I think the data is suggesting a range-bound movement. So we may see oscillation within this particular band itself throughout the day, 25,740 on the lower side and 25,880 on the higher side.
Got it. Okay. All right, Sachi. So you're saying a bit of a range in the near term. But individual stocks are providing opportunities, right? What's your view?
Good morning, Nigel. Absolutely. I think there are relative outperformers which are still doing well, pretty well. In fact, if you look at stocks like SRF, something that we have also recommended to our clients. Now, this particular stock is still continuing its higher top, higher bottom sequence. On the 60-minute scale, we have seen a fresh breakout from a bullish pennant formation. The pattern itself is indicating a target somewhere close to around 3130. So even here right now, in case if we see any dips, the ideal level to accumulate would be somewhere close to around 3020, 3030 band. The stop loss for the trade should be placed at 3,005 on closing basis. and positions can be reviewed at around 31.30. The other stock which has seen a significant short covering is Divi's Lab. Now, if you look at the overall structure, the stock was struggling to maintain its bullish stance. But if you look at the past 15 trading sessions, it was seeing meaningful support base at around 6,300. We wanted to see a closing about that 6,400 mark, but if you look at yesterday's price action, we saw a inverse hammer formation, again reconfirming the support at 6,300, and the high of that particular pattern has been breached right now. So we are expecting that there could be a significant short covering move unfolding in this particular counter, and hence we are recommending building fresh long positions in DVs. The stop loss for the trade can be placed at around 63.80 on closing basis. First target would be around 6,500, but initially, I think we may see this particular rally getting extended towards 66.30 as well. So buy call on Divi's Lab and a buy call on SRF. All
right, buy call on Divi's and buy on SRF. Wonder if you've looked at a couple of these, pharma names as well. Midcap pharma doing extremely well. We have Biocon, which has seen a bit of a spike. This, was consolidating for a bit. Now it's up around 2%. From the front line, we have Divi's, which too is fairly high right now, at the high point. Is there any pick from this segment?
Mangalam, Divi's Lab is something that I've recommended right now. And I think you mentioned Biocon. Even here, the data is very important. Now, we have seen a kind of consolidation near its 50-day exponential moving average support at around 385. And the significant part is that there has been a positive crossover on its daily RSI, which is a good sign of improving strength. So I think one can also consider Biocon on the long side, but the stop loss should be kept at around 388 itself on closing basis. On the higher side, in case if the stock sustains above that 400 mark, then there could be a significant rally towards 415, 420 zone. So for the day, at least 400 can be a decisive target, but on the lower side, 388 should be your stop loss.
All right, take that point. Thank you so much for joining in, Sachi. With that, let's get you some more ideas for profit. In fact, our colleagues from Money Control Pro are standing by. Sachin Pal joins in with the stock. Sachin.
Yeah, thanks. The stock that we have chosen today in our ideas for profit is Dixon Technologies, which is a contract manufacturer operating primarily in the consumer space. The stock has been under pressure in recent months, primarily due to multiple concerns surrounding its business as well as the industry. Firstly, the stock in Q2 had revenues of almost 28% year-on-year, which was a moderation from the earlier levels of almost 80 to 100% that the company has been witnessing for the past several quarters. Secondly, concerns around the expiry of the PLI scheme is likely to have a substantial impact on the overall business profitability, and that should have some bearing in terms of the near-term performance of the company going into FY27. Thirdly, the stock EMS business space has also been under pressure, and also there have been news flow around the delays in approval with the Vivo JV with the company has been pursuing for the last 12 months. Nonetheless, the business is backward integrating into many modules on the mobile space, the display modules as well as the camera modules and the battery manufacturer. Battery modules should have give a lot of fill up in terms of the overall wallet share from 15% in the mobile to almost 40% in the next 2 to 3 fiscal years. Overall, earnings remain on a very strong footing, and the EBITDA of the company is likely to double from current levels in the next 3 to 4 years. The stock has also seen a correction of almost 25% from its all-time highs that currently trades around 20 times FY28 estimated EV by EBITDA, which we believe is very reasonable for accumulation from a long-term standpoint.
Okay, all right. Thanks a lot for that. Well, time to slip into a short break. You come back. We'll continue to focus on markets, and we'll focus on the stocks that are moving around. Don't go anywhere.
Welcome back. The mid-cap index has turned. It's now moved into the green from just mild red when we started the show. And a couple of these real estate stocks doing well. Oberoi Realty, for one, comes up for you, currently at the high point of trade. We're also seeing some traction build in Vodafone Idea. Now, the stock has recovered about 5% from the lows. Obviously, it's a smaller denomination stock, so 5% of lows would just mean a few paise, but there has been a recovery nevertheless. And even the number of stocks that were advancing have moved from 880 to over 1,000 in just the last 10 odd minutes or so. But amidst all of this, one stock is under pressure. The top loser on the Nifty is Sun Pharma, following some regulatory action coming in from the US FDA for their Basca facility. Ekta joins in.
Well, yes, Sun Pharma is in focus in today's trading session on the back of negative news with regards to their Basca facility, which has been classified by the US FDA as an official action indicated status, which basically means that there are compliance issues in that particular facility. Now, the plant was inspected from the 8th to the 19th of September 2025. The company has said that they continue to manufacture and supply approved products from this facility to the US as of now. Now, analysts say that Basca facility is probably one of the most important facilities for Sun when it comes to their new complex generics. And hence, the probability to deliver a potential positive surprise in the generic business might be lower for Sun Pharma as of now. But the official action indicated status as of now does not change the forecast, because analysts are not really pegging in a lot of complex generics in their forecast when it comes to approvals and sales from that particular segment. And hence, however, going forward, the approval timelines could change because of the compliance issues at the Basca facility. Now, remember that there are other facilities which are under the US FDA scanner, which Sun has. For example, the Halol facility, which has had an import alert since June 2022 and was classified as an official action indicated status post a June 2025 inspection. And they have the Mohali plant, which also has a consent decree or was sent a non-compliance letter in 2023. So yes, negative news for Sun Pharma, but how they basically respond to any kind of compliance issues will be critical to see in terms of what the complex generic pipeline could look like for the company going forward.
Well, thanks, Ekta, for that. Appreciate you joining and giving us an update on Sun Pharma. But the big sector that's moving today is some of those capital market plays. You have Surbi, who's joining in to tell us about SEBI overhauling some of the MF regulations. Surbi, over to you.
Well, thank you for that. Yes, finally, after 3 decades, the market regulator has overhauled mutual fund regulations. The last ones were in 1996, and now we are virtually in 2026. Now, what has happened? Basically, the total expense ratio has been unbundled, and a new concept called the base expense ratio has been introduced. Now, what does this really mean? Statutory levies and the brokerage fee that mutual funds pay to brokers for executing their trades, they are, away from the base expense ratio. So the new formula for TER, total expense ratio, is the base expense ratio plus the statutory levies or taxes, CTT, GST, etc., plus the brokerage charge. Now, there is a reduction in 2 of these parameters, the base expense ratio and the brokerage. So let's dive deeper and understand each of them individually. Because now taxes and levies are no longer part of the expense ratio, the expense ratio itself has to be lowered to factor in for it. And therefore, SEBI has gradually reduced the base expense ratio across schemes, close-ended funds, open-ended funds, equity funds, non-equity funds. But what's important to note here is that the reduction in the expense ratio is less onerous than what the market had feared earlier. And this is especially true for large-size funds, funds which have an AUM of more than 2,000 crores. In any case, the way the regulations have always been, expense ratios reduce as the size of the fund increases. But now for large funds, the good news is that the cut is not 15 basis points, as was being proposed in October. The cut is just about 10 basis points. So that's as far as the expense ratios is concerned, the base expense ratio. The other big part of this regulation is the brokerage fee, the amount that mutual funds are paying to stockbrokers to execute, whether they're derivative trades or their cash market trades. Now, here also there is good news for brokers, especially because the reduction is not as severe as what was being proposed in October. So at a net level, earlier, mutual funds could pay up to 8.59 basis points. Now that cap has been reduced to 6 basis points. It's still a hit for brokers, but it's not as bad as the 2 basis points that was being proposed in the old consultation paper. And for the derivative trades, this has been capped from 5 basis points to 2 basis points. In a nutshell, SEBI seems to have walked some sort of a middle ground. It has given large funds what it wanted, not a very severe reduction in the expense ratio. It has given brokers some relief by not reducing the brokerage fee too much, and it has definitely given investors plenty of delight, more transparency, and a complete understanding of what we are paying as expenses when it comes to our mutual funds.
Take that point, Zarbi. Thanks a lot for that. So all the fact that, there has been considerable middle ground which has been achieved by the SEBI has the street relieved, and we've seen a big spike in a lot of these capital market plays as well. Take a short break, come back, get you more of the markets and a lot of buzzing stocks on the other side.
Welcome back. Well, just keep an eye out on a few stocks that are moving around. Walchand Nagar is one stock that spiked up in the last minute, so I think we should get that one up for you on the screen. Remember, these are stocks that have seen a sharp pullback. You pull up Genesis as well. That one is up close to 10% the last time I checked. So big up move is what you're seeing. And some of these metal-related names, whether you're looking at Hindustan Copper, Vedanta, Nalco as well, they've recovered from the low point of the day. But another one is Hero MotoCorp. That's under pressure following a bearish note coming for Jefferies. Hormuz joins us to tell us more about that. Hormuz?
Yes, Nigel. It's a downgrade that has come in from Jefferies on Hero MotoCorp. They have downgraded their rating to underperform from their earlier rating of neutral from hold, and their price target has also been slashed to 49.50 from 55.50 earlier, which now implies around a 15% downside from current levels. Now they say that although they remain positive on the two-wheeler demand outlook, but they go on to add that the GST reform-led demand boost that Hero MotoCorp had received has waned out in the month of November and December, and the registration market share has also dropped in the month of December after that seasonality-led improvement in the month of November for Hero MotoCorp. The stock has done well this year. It's up around 40%, and that is also due to as a result of which the valuations have expanded as well. And at 20 times FY27 price to earnings, the brokerage finds the valuations to be expensive, and therefore the downgrade, the stock down in today's session.
All right, the stock down in today's trading session. Hormuz, just before we come to you for Voltas, keep an eye out on Meesho. Now the stock has corrected about 11% from highs. The market cap this morning crossed that 1 lakh crore mark. And remember, the first few days post-listing, there are exaggerated moves on either side, and that's largely because of a limited float which is available. And in Meesho's case, there are a lot of the anchor investors decided not to partake in the anchor book and perhaps would have bought post the listing as well. That would have caused a bigger spike in demand. Then there was a brokerage note that came by yesterday as well. But today, from the highs, the stock's seen a bit of a knock. Currently at the low point of trade, down about 4%, has corrected about 11% from the highs. But Voltas holds up in green, Hormuz.
Indeed, and that's of course a double upgrade that has come in from BofA, and they've double upgraded it to a buy. Their earlier rating was an underperform rating, and they've raised their target to 1555 from around 1250 rupees earlier. And they believe that Voltas is going to be the biggest beneficiary of potentially normal summer in calendar year 2026. And pent-up demand, low base, and cost tailwinds are some additional reasons why they have upgraded the stock. They expect the third quarter to remain subdued because of the seasonality factor, but then they go on to add that all of that is already priced in for the stock, and as it is, they expect a very sharp earnings rebound of a 44% CAGR over FY26 to 28. That is of course on a low base, but an upgrade coming in for Voltas. The stock gave up some of the early gains, but still holding on to some green.
Thanks a lot for that, Hormuz. Well, on that note though, we'll have to wrap up on this edition of Chartbusters. You stay tuned. The team of Trading Hour is waiting by.